Kevin O'Leary is a very wealthy investor who is reported to be worth approximately $400 million. He is most well known for his work on the popular television program Shark Tank. What you might not know is that Kevin loves investing in dividends so much that he created his own ETF that focuses on high-quality companies that pay dividends. In this video, I'll discuss O'Leary's fondness for dividend equities and examine the dividend ETF he owns. We will unfold why Kevin O'Leary has dividend stocks and more about ETF OUSA. So if you haven't already, make sure to subscribe and hit the notification bell. It's free and you can always change your mind later on. And that way, you can also be easily notified whenever we upload new ideas on how to earn more money. So it's a win-win. With that said, let's get back to the content, shall we? I'll discuss why Kevin O'Leary favors investing in dividend-paying equities and provide a summary of the ETF he created especially for this purpose. Among Kevin's key arguments is that cash flow should come first when choosing an investment, which makes sense given that the only effective way to return capital to shareholders is through positive cash flow. A stock is only a small component of a company, as Warren Buffett frequently points out. Therefore, the same considerations apply when purchasing stocks. If you were to own the entire company, you would need to earn a profit and get a return on your investment. If you can't produce a positive cash flow as a company owner, you won't make any money. Perhaps the only alternative choice is to resell the company or sell it to a different buyer for a higher price, who also hopes to eventually make a profit. This is purely conjecture, as Kevin has stated. In the end, if your company has no way to generate cash flow, long-term stockholders will not value it. Kevin justifies buying dividend stocks using this line of reasoning. The only way for a shareholder to make money without partially liquidating their investment is through a dividend. He also brings up the statistic that dividends, not capital gains, account for 71% of all market returns. And furthermore, consistency and diversification are two key factors that Kevin looks for in his investments. He keeps this in mind when creating his dividend ETFs for this reason. Kevin hinted that dividends account for the lion's share of market returns. So let's look at his dividend ETF, OUSA. Why is this the case? It has to deal with the concept of compound interest. Compound interest is the most potent force in the universe, according to Albert Einstein. The S&P 500's price return since 1957 is nearly 6,500%. Over 46,000% is the total return when dividends and compounding are taken into account. This indicates that dividends and compounding account for about 80% of the potential total return the investor would have earned. Profitable dividend-paying businesses have the capacity to sustain and increase their dividend payments over time, which makes the situation even better. With a growth rate of about 11% annually from 2010 to 2019, the dividends per share distributed by the S&P 500 companies more than doubled. Okay, let's look at the businesses that are in OUSA. Microsoft, Johnson & Johnson, Home Depot, Procter & Gamble, Merck & Co., Verizon, Pfizer, Apple, Cisco, Honeywell, United Health Group, Amgen, Coca-Cola, Lockheed Martin, PepsiCo, and 3M are among the top holdings of OUSA as of December 2020. Before we proceed, please leave a comment below stating which country you're from so that we may create more customized content for your location. With that said, let's continue. The ETF has 101 holdings in total and is curated to contain high-quality, large market cap dividend-paying businesses. Healthcare accounts for 22% of the ETF, followed by information technology at 21%, consumer staples at 16.5%, industrials at 14.8%, and so forth. Since the fund's launch in July 2015, its price has increased by 52%. Additionally, it distributes to owners monthly dividends that fluctuate in size according to the portfolio's dividend return for that particular month. The most recent distributions per share are seen here. Although it is relatively low at 2.08%, The yearly dividend yield is better than that of indices like the S&P 500. With an expenditure ratio of 0.48%, OUSA requires you to pay an annual fee equal to 0.48% of your net assets. This is intended to cover all expenses spent by the fund, including management fees, administrative costs, business running costs, and other expenses. The fact that you lose a piece of your assets to fees each year, regardless of whether the fund makes money or not, is one of the reasons why I don't like ETFs and managed funds. These expenses may significantly reduce total returns over the long term. It's also important to bear in mind that with these funds, you have no influence over the investments they make, which is critical if you prefer to have more control over your assets. For instance, OUSA owned 9.3% of its portfolio in the energy sector in December 2019, with a total stake of 5% in ExxonMobil and 3.24% in Chevron. By 2020, they had totally sold out and their portfolio had no energy-related investments. Although I'm aware that this industry was severely hit in 2020 and that stock prices fell sharply, I believe that companies like Exxon and Chevron would be able to recover in 2021 and beyond because they have strong balance sheets and were able to maintain their dividend payments throughout the worst oil year ever. OUSA would seem to have had to reload at a cheaper price per share, if anything. Just at the start of 2020, they had such strong feelings about these companies. ETFs have a low risk tolerance and are hesitant to accept short-term losses in exchange for long-term gains. They must preserve and increase value for their clients, which is the rationale for this. If they incur significant short-term losses, their clients will leave and their money will begin to decline. This is more of an overall bet on ETFs and not necessarily on OUSA. I believe OUSA is a good dividend ETF and is perfect for those who want to begin investing in dividends, but don't want to conduct their own research or stock selection. Even if you aren't interested in ETFs, researching dividend funds can still be beneficial. You can look at their holdings to get a sense of what they invest in, and it may even inspire you to create your own portfolio. Kevin breaks his rule about avoiding investing in firms that don't pay a dividend despite saying he loves dividends, and invests a substantial percentage of his net worth in OUSA. Growth equity should also be included in your portfolio, despite what would seem hypocritical to some people. Another ETF owned by Kevin is named OGIG, strategies centered on major international internet players like Amazon, Alibaba, Facebook, Alphabet, Microsoft, Shopify, etc. This fund has increased by 112% this year. Dividend investing is not a creed that you must adhere to strictly. However, it is a good addition to your portfolio and can help you create a passive income stream. Thanks for watching. I hope you learned something useful today. And if you haven't already, make sure to subscribe and hit the notification bell so you'll be updated whenever we upload new videos. Till the next one, goodbye!